Hey there, Mad Money viewers. The market's been a wild ride lately, hasn't it? We've seen some dramatic ups and downs, and it's got everyone talking. From Wall Street to Main Street, the question on everyone's mind is the same. Have we finally hit the bottom? Volatility is off the charts, and everyone's wondering, have we hit bottom yet? It's been a roller coaster with stocks swinging wildly from one day to the next. Investors are on edge trying to make sense of the chaos. Well, I'm here to tell you, things might be looking up. There are some encouraging signs that suggest we could be turning a corner. The market has shown some resilience, bouncing back from recent lows. My man Tom Lee, one of the smartest guys on Wall Street, is feeling optimistic. He's been analyzing the data and believes that we might have seen the worst of it. Tom's insights are always worth paying attention to, and his optimism is a good sign. He thinks we might have seen the worst of it in the past couple of weeks. The market has shown some signs of recovery, and that's giving investors a glimmer of hope. But it's not just about the numbers, it's about the sentiment. Of course, there's still a lot of uncertainty out there. The global economic landscape is complex, and there are many factors at play. From geopolitical tensions to economic policies, there's a lot that can influence the market. The trade war with China is heating up, and that's got investors on edge. Tariffs and trade barriers are creating uncertainty, and the market doesn't like uncertainty. It's a delicate situation that requires careful navigation. But here's the thing, the market hates uncertainty more than it hates bad news. When there's a lack of clarity, investors tend to pull back. But when we start to get a clearer picture, even if it's not all good news, the market can stabilize. And right now, we're finally starting to get some clarity. Recent developments are providing a bit more direction, and that's helping to calm some of the nerves. It's not a complete turnaround, but it's a step in the right direction. We're seeing some positive signs, folks. The market is showing some resilience, and there are indicators that suggest we could be on the path to recovery. It's a cautious optimism, but it's optimism nonetheless. The Fed is signaling that it's willing to cut rates if necessary. This is a big deal, because lower interest rates can stimulate economic activity. It's a tool that the Fed can use to support the market, and their willingness to act is reassuring. And companies are still reporting strong earnings. Despite the volatility, many businesses are performing well. Strong earnings reports are a positive sign, indicating that the underlying economy might be more robust than the market's recent behavior suggests. So, while I'm not saying it's time to go all in on stocks, I am saying that there's no need to panic. It's important to stay informed and make decisions based on data, not emotions. The market can be unpredictable, but with the right strategy, you can navigate these turbulent times. Keep your cool, stay informed, and remember, fortunes are made in times like these. It's during periods of uncertainty that opportunities arise. By staying calm and making informed decisions, you can position yourself for success when the market stabilizes. Now let's talk about these tariffs. President Trump's been slapping them on everything from steel to solar panels. And while I applaud his efforts to protect American jobs, there's no doubt that these tariffs are having a real impact on the economy. Businesses are facing higher costs, which they're passing on to consumers in the form of higher prices. And that's putting a damper on economic growth. But here's the good news. Trump knows that he can't keep this up forever. He's a deal maker at heart, and I'm confident that he'll eventually reach an agreement with China that works for both sides. In the meantime, we need to be prepared for some bumps in the road. The trade war is creating uncertainty, and that's never good for the market. But remember, this too shall pass. So what's a savvy investor to do in these uncertain times? Well, the first rule is, don't panic. When the market takes a dive, it's tempting to sell everything and run for the hills. But that's the worst thing you can do. Remember 2008? The market crashed, and everyone thought it was the end of the world. But those who held on to their stocks and even bought more during the dip came out ahead in the long run. That's because they were buying low and selling high, the golden rule of investing. My strategy is simple. I buy stocks that I believe in for the long haul. And when the market drops, I see it as an opportunity to buy more of those stocks at a discount. It's like shopping at a Black Friday sale. Now, I know what you're thinking. What about a recession? Are we headed for one? Well, it's definitely a possibility. The economy is slowing down, and some experts believe that a recession is inevitable. But here's the thing. Recessions are a normal part of the economic cycle. They happen every few years and they don't last forever. In fact, The average recession since World War II has lasted only 11 months. So even if we do have a recession, it's not the end of the world. The market will eventually recover, and those who stay invested will be rewarded. Section 5. Timing is everything. Why you're probably wrong. Now, I know there are some folks out there who think they can time the market. They believe they have the insight or the secret formula to predict the market's next move. They watch the news, follow trends, and analyze data, convinced that they can outsmart the system. They think they can predict when it's going to go up and when it's going to go down. They spend countless hours studying charts, reading financial reports, and listening to market pundits. They believe that with enough information, they can foresee the future, and they're always trying to buy at the bottom and sell at the top. They dream of catching the perfect wave, of making that one big trade that will set them up for life. But the reality is far more complex and unpredictable. But here's the truth. Timing the market is incredibly difficult, even for professional investors. These are people with years of experience, advanced degrees, and access to the best tools and information. Yet, even they struggle to get it right consistently. And for most people, it's a recipe for disaster. The average investor doesn't have the time, resources, or expertise to compete with the professionals. Trying to time the market often leads to emotional decisions, buying high out of fear of missing out, and selling low out of panic. You see, if you miss even a few of the best trading days, you can significantly hurt your returns. The market's biggest gains often come in short, unpredictable bursts. Missing just a handful of these days can mean the difference between a profitable investment and a disappointing one. So instead of trying to time the market, I recommend a strategy called dollar-cost averaging. This approach takes the guesswork out of investing. It allows you to build your portfolio steadily over time without the stress of trying to predict market movements. That means investing a fixed amount of money at regular intervals, regardless of what the market is doing. Whether the market is up, down, or sideways, you keep investing. This disciplined approach helps you avoid the pitfalls of market timing. This way, you're buying more shares when prices are low and fewer shares when prices are high. Over time, this can lower your average cost per share and increase your potential for gains. It's a simple but effective way to reduce your risk and increase your chances of success. By staying consistent and avoiding the temptation to time the market, you can build a solid foundation for your financial future. Section 6. Playing it safe. Sectors that thrive in turmoil. Now, if you're really worried about a recession, there are certain sectors that tend to perform better than others during economic downturns. These are sectors that provide essential goods and services that people continue to need even when times are tough. One such sector is consumer staples. These are companies that make things like food, beverages, and household products. People still need to eat and drink even during a recession, so these companies tend to hold up well. Another sector that typically outperforms during recessions is utilities. These are companies that provide essential services like electricity, gas, and water. Again, these are services that people can't live without, so these companies are relatively recession-proof. Section 7. My top stock picks for weathering the storm. In today's volatile market, it's crucial to have a strategy that not only protects your investments, but also positions you for future growth. With that in mind, I've carefully selected a few stocks that I believe are well equipped to weather the storm and come out stronger on the other side. Alright folks, now, for the moment you've all been waiting for, my top stock picks for weathering the current market storm. These aren't just any stocks, these are companies with robust business models, strong financial health, and a proven ability to adapt to changing market conditions. These are companies with strong fundamentals, solid track records, and the potential for long-term growth. They have consistently demonstrated their ability to innovate and stay ahead of the competition, making them ideal candidates for your investment portfolio. First up, we've got Microsoft. This tech behemoth has been a staple in the industry for decades, and for good reason. This tech giant is a cash cow with over $75 billion in cash on hand. Their financial stability is unmatched, providing a solid foundation for future growth. They're investing heavily in artificial intelligence, which is the future of technology. From cloud computing to AI-driven solutions, Microsoft is at the forefront of technological innovation. And their Windows 11 upgrade is a hit with consumers and businesses alike. This new operating system has been well received, driving further adoption and customer satisfaction. Next, we've got Palantir. This data analytics company is on fire with 64% year-over-year commercial growth. Palantir's unique approach to data analysis sets them apart in a crowded market. They're helping organizations make sense of their data, and their services are in high demand. From government contracts to commercial applications, Palantir's solutions are indispensable. And finally, we've got NVIDIA. Known for their cutting-edge graphics processing units, NVIDIA is a leader in the semiconductor industry. This semiconductor giant is the leader in graphics processing units, which are essential for everything from gaming to artificial intelligence. Their GPUs are not only popular among gamers but are also critical for AI research and development. They've got a strong track record of innovation, and their future looks bright. With a focus on AI and machine learning, NVIDIA is well positioned to capitalize on the next wave of technological advancements. So, there you have it, Microsoft, Palantir, and NVIDIA. These companies are not just surviving, they're thriving, making them excellent picks for weathering the market storm. Section 8. The future is now, agentive AI and your portfolio. Now let's talk about the future. Artificial intelligence is already changing the world as we know it, and it's only going to become more important in the years to come. One of the most exciting developments in AI is the rise of agentive AI. Agentive AI refers to AI systems that can act independently and make their own decisions. These systems are still in their early stages of development, but they have the potential to revolutionize a wide range of industries. For investors, agentive AI represents a huge opportunity. Companies that are at the forefront of this technology are well positioned for explosive growth in the years to come. So, if you're looking for long-term investment opportunities, agentive AI is definitely worth keeping an eye on.